Hello everyone, and welcome back to another CRT YouTube video. Now this specific episode is on order blocks and how we can use them to get our low timeframe entries while trading CRT. We will go over how they are formed, why they are so important, how to use it for a Model 1 entry, and most importantly, how you can correctly identify an order block. After watching this episode, I am pretty sure that there will be no questions remaining on order blocks, but if you do have any, feel free to ask them down below. Post-video, you should be able to differentiate the different forms of order blocks, identify it, and integrate it into your CRT trading model. So let's now get into it. Let's begin by clearly defining what an order block is to help you better understand this concept. Over the years, ICT has provided various interpretations, but based on his initial explanation, my own 5+ years of analysis on the charts, and the specific trading approaches of Romeo and Sham, I have refined my own definition. A lot of people, including ICT, will say that an order block is the last down close candle or the last up close candle before the downwards move, and this is their definition. This is not, however, what myself, Romeo, and Sham use. The reason being is that what they are doing is pattern trading, and we like to use sound logic. We must seek a logical framework when trading. If you use the general pattern trading order block technique, it will be low probability a lot of the time, and it will not work for you, and you will miss explosive moves because of this. So how do we solve this problem? We must use the most refined, objective, and logical definition that we can find for an order block. So I've gathered all the data from ICT, Romeo, and Sham, and this is what I've come up with. So, an order block is a candle or sequence of consecutive candles, meaning that it can be a single candle or multiple, that purges liquidity in the form of a previous high or low, or it fills liquidity. So this is it in its basic form. Now when these candles get engulfed, and the price then closes above or below it, an order block forms, meaning that candle or that sequence of multiple candles turns into an order block when the price closes below or above it. Now this is exactly how you can define an order block in the most refined and objective manner based on proper logic. Using this definition alone will change your whole perspective on order blocks and definitely increase your profitability. Before continuing, I do want to once again shout out Romeo for teaching me pretty much everything that I know, and also Sham for helping me with video ideas. Now let's take a look at the core concepts of order blocks. So why are order blocks so significant, and why is it considered a valid key level? The main reasons that order blocks are considered valid are because when price closes below or above an order block, price will use it as a future reference key level to react off. So the first core concept of an order block is that it has to purge liquidity. This is the main concept for a key level. So an order block must either take out liquidity by purging above the highs or below the lows. The second core aspect that an order block has is that it fills liquidity in the form of filling or testing FVGs or unmitigated order blocks. So this is the best way to actually identify an order block. It does not, however, need to have both of these aspects to be considered valid. It only needs one of them. Now we will be looking at a few examples of how price actually purges liquidity and how order blocks form. So right here, you can see that we've got this range low, and beneath this low lies liquidity. We know that above highs and below lows lies liquidity. Now what happens is that price comes back down and purges this low, meaning it purges liquidity or takes out liquidity, and it does it with a sequence of consecutive candles. This particular candle right here is the specific one that purges the liquidity and takes out the liquidity, meaning it takes out the low, but then also the next two candles will also play a role in purging the liquidity. So price manages to move above and close above these candles, and we are only regarding this sequence of candles that breaks and moves below the low as an order block, and you can see what happens is the price moves above, then closes above these candles with this particular candle right here, and now these candles are considered a valid order block. The reason for this is they have followed the two main important rules for an order block. Number one, it is taking out and purging below this low, and then our second aspect is that the price manages to close above it. So this is valid, and you would be waiting for a retest before entering your long trade. On the retest, this is your Model 1 entry. Let's move on to the next example. So, right here you can see that we've got this range high, and what happened is that the price purged that high with this particular candle. This action indicates that liquidity above the high was taken. Now, once the price closes below this candle, it marks the creation of a bearish order block. You can see here that the price closes below it, then retests this bearish order block and reacted to it explosively, causing the price to expand lower again. Once again, this would be a valid Model 1 entry on the retest. So right here, first of all, you can see that with this candle, we took out a low to the left, effectively purging liquidity by taking it out. So when the price goes below that low, purges it, and then closes above it, it becomes a valid bullish order block. That's exactly what happened. Price closed above it, came back down to test it, which would be our Model 1 entry again, and then reacted off this area. Now what you can also see here is that before we did test this bullish order block, we formed a low, which generated liquidity below it. Price then moved down and took out this low with this particular candle right here. This again aligns with our definition of an order block. You can see that we took out the range low and purged the liquidity below it with this candle. Not only that, but this candle also tested a previous existing order block, meaning it also grabbed liquidity. This candle has done two things. It purged liquidity and filled liquidity by testing a prior area. So now, when price closes above this level, it becomes a high probability, high quality order block. You can see how the market reacted to this order block and expanded explosively above it. This is an example of a high probability order block which not only purged liquidity but also filled it. Now let's move on to an example of an order block which only fills liquidity, and let's see how it looks and how it forms. Here we can see a fair value gap. What happened is that this down close candle filled the liquidity in the form of testing this FVG. Notice that this candle performed a crucial function that needs to occur before an order block is considered valid. It filled the liquidity, effectively testing the level. When the price closed above the candle, it became a valid order block. You can see that the price then moved lower, tested the order block, giving our entry, and then reacted and led to a strong upwards movement. Additionally, you can observe another order block of a similar nature here. This candle tested a previously existing order block, filling the unfilled liquidity of this untested order block. When the price closed above this candle, it also becomes a valid order block, and the price subsequently tested it and reacted just as expected. So these two examples on the screen right now did not purge any liquidity, it just filled it, meaning it is a valid order block. Now let's move on to our next slide and discuss whether we will be using the body or the wicks for an order block. The simple answer is there is no black and white answer. It really does just depend on the scenario. You have to decide off how price action forms and reacts to the order block, and only then can you decide whether the wick or body of the candle is the official order block. So the two different scenarios we have are the following. 1. If price closes just above or below the open of the candle, then you would just use the body as the order block. This is because price only closes above the open and not the wick. Our second scenario would be the opposite of the first. This is that the price closes below or above both the open and the wick, or the high of the candle. Then in this case, you would use the whole candle as an order block alongside the wicks. Now let's take a look at a few examples. So here we can see that this candle purged the liquidity, but then the price managed to actually close above the low, but it only managed to close above the body or the open of the candle, but not the wick. So in this case, you will only choose the body of this candle as your order block. This will then be your Model 1 entry, and price should then react off it. Now in this example, you can see that the price purges the liquidity by taking out this CRT low. We then see the price close above the candle that purges the liquidity, but it only closed above the open, not the high. So in this case, we again use the candle body as the order block, and not the wick. So in this example here, that was shown earlier in the video, we only choose the body of this candle as the order block, and now you know why. You might have been wondering why I didn't choose the wick, and now you know. It's because price only closed above the open or the body. So here is another example, and in this case, price did actually manage to close above the whole candle, including the wick or the high. So here, we would actually use the whole candle as our valid order block. Now here is our final example before I explain a little more. We can see here that the price did actually manage to close above the wick and the high, so the whole candle would once again be used as our order block. So this is really how easy it is to differentiate between the two forms of different order blocks, and tell whether you want to choose the open or body of the candle, or the entire candle, including the wick too. So it is the same as any of our CRT teachings. We use proper objective logic and reasoning instead of randomly pattern trading it. Another efficient way of choosing whether to use the body or the wicks is by looking at the actual length of them. If the wick is significantly smaller than the body, use the body as the order block. This is even including if the price has closed above or below the wick. If the wick is significantly larger than the body, use the wick as the order block. You can implement either approach, the earlier one, or the one I have just shown you. It really depends on what suits your trading style the best. Do not use both, only choose one. Now when you implement this on the lower time frame for your entries with CRT, you will be unstoppable. I hope you have enjoyed this video on low time frame order block entries within CRT. I also hope that you did take notes, as I will be showing you a few examples for homework for you to tag me in on Twitter and show me your entries. Happy trading, guys. Always remember to manage your risk, and see you next Sunday for the next CRT video.